Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, good morning.
Good morning, Prashant. Good morning, Nigel. I just feel that Brazil is the latest missile that's been fired. And the thing that really caught my eye was, so far it was all about trade deficits. Country A is running a very high deficit with us, or B. But this was suddenly about internal politics. I think he used the word punishment. It's a punishment for, I think, the previous president and, whatever's happening there. So, never a dull moment. Let's see.
Well, that's right. And today is Guru Purnima as well. So wishing all our viewers as well a happy Guru Purnima. And let's hope for a good day.
Absolutely. And markets have quietened down, as I think we were highlighting right at the beginning of the week, actually. And I think it's played out like that. Let's just start with, take it from the top, right? And Brazil is top of mind, absolutely top of mind. So Trump has basically announced 50% tariffs on Brazil exports from Brazil into the US. This is opposed to a 10% rate which was set on Liberation Day. Now, if you go through the letter, which has been sort of sent across to Brazil, it talks about internal politics and a couple of other things as well. But I think what needs to be remembered is that Brazil is the B in BRICS, BRICS. There is Brazil, India, China, Russia, South Africa now, of course, as well, right? I mean, originally it was just BRIC, now it's BRICS, with South Africa added. Remember, Trump has been railing and ranting about the BRICS grouping, at least for the last 48, 76 hours. He threatened, just on Sunday, he threatened an additional 10% tariff on BRICS countries. I mean, for just being part of BRICS, not about doing anything. But if you are one of the countries in BRICS, you will get a 10% tariff, which will be imposed, additional to whatever your tariff rate is, right? And yesterday we got that number was not additional 10%, it was total of 50%, far higher than what we thought. Now, if you look at Brazil and what it sort of sends into the US, it's about 2%, less than 2% of US imports. So, the worry is, or the fear is, or the anxiety is that actually, the real reason why Brazil has got this tariff, this very high 50% tariff, is essentially the fact that it is part of this BRICS grouping. And if you remember, we played out that soundbite yesterday as well. President Trump essentially saying that if you want to undermine the US dollar, there is a price to be paid for that. So I think this is what the bigger question is. Is the BRICS bloc really in Trump's line of fire? I spoke with Jim O'Neill. He's the man who coined the acronym BRICS yesterday. And he essentially said that actually, if anything, all this mention of BRICS by President Trump is elevating the grouping to a status it does not deserve. There is no chance of a common currency or anything of that sort, but it does not matter. I mean, it is essentially what President Trump perceives. So in that line, I mean, just a thought, will the other countries, I mean, the I and the C and will we see some pressure in terms of especially currencies, forex, as we start today? So keep an eye out on, the yuan, maybe to a little lesser degree, the rupee as well. Because, here in India, we, of course, have been trying to negotiate a deal, which seems to be elongated now. It's not happening. It's not happening quickly. We're not first in the line in that sense, but it's taking time. Now, the Wall Street action yesterday was actually quiet. It was a very well-behaved day, but it was higher, 0.6 on the S&P. The Dow was up 0.5. The Nasdaq was up about 0.95% as well. So pretty good. Actually, the large super tech stocks is what took the markets higher. And of course, some of the really sold down, heavily shorted names also participated. VIX, by the way, the CBOE VIX is now in the 15 handle. FOMC minutes were largely a non-event. Fed pricing is unchanged, and I think that's the indication straight up which tells you what the minutes really did or did not do. And there was another thing, right? Out of the Middle East, oil prices still about 70, so not very much change. But President Trump said that the negotiations were very close to a ceasefire between Israel and Hamas. And I think there was another official who said that perhaps we'll see something coming through. We'd like to see something announced by this weekend by Saturday or something. So I think it's close by if they're able to do this. the levels don't change. Yesterday we had a down day on the Nifty Bank, etc. But it was nothing spectacular. I mean, none of the supports we've been putting out for 2 days, these numbers, these levels now, they're not really changed. Those were not hit. So 25,331 is the support, 25,669 is the resistance. We're still in that range for the Nifty Bank as well. The resistance is 57,628. The support stands at 56,838. So that's basically the the levels as we look at them at this point in time. GIFT Nifty will give you a sense of how we are starting. That's almost unchanged. I mean, 2 points lower on the GIFT Nifty. Surabhi.
It's become a bit of a habit for the market, right? Though it did move yesterday, but it moved on the lower side, the index, managing to still be in a very tight range. Actually, most Asian markets are more up than down this morning. The one that's clearly lower is Japan. But the other markets like mainland China, Hong Kong, you're seeing some flashes of green here and there. Singapore is also up about 0.25%. So it's not too bad across Asia. Obviously, markets are digesting all these tariff missiles that are coming in. Remember, Moldova, Brunei, there were a lot of other smaller countries where those tariff letters went out last evening. The big headline, obviously, was Brazil. On FOMC minutes, the minutes did move the US Treasury market because yields fell on hopes that more rate cuts are coming sooner rather than later. The 10-year yield was down about 8 basis points. The 30-year yield was down almost 7 basis points as well. And the 10-year now is below the 3.4% handle. In fact, I was looking at it just right, 4.3%, sorry, beg your pardon. So from 4.4, we're now looking at levels of 4.33. That's the change that's happened. So what did the FOMC minutes say? I just want to pull up the quote there, exact quote from the minutes. Most participants assess that some reduction in the target range for federal funds rate this year would likely be appropriate. So it just gave the market reason to believe that rate cuts are indeed coming sooner rather than later, perhaps. NVIDIA, of course, the other big headline, touching $4 trillion in market capitalization. The NVIDIA juggernaut continues. And the NASDAQ itself closed at fresh all-time highs yesterday. So tech was a good space. This morning, South Korea's central bank has left interest rates unchanged. The economy was in contraction in the first calendar quarter of this year. The rates are at a near 3-year low at about 2.5%. Now we're watching out for the trade framework. Of course, the India-US trade deal and what happens there, and the US-EU trade deal. There's still some sense that something could get done by the end of this week. By the way, Bitcoin was in strong demand yesterday. That was another headline. It's now almost touching, $112,000. Came in at a record high yesterday as well. For us, consolidation has been the name of the game, absolutely directionless for the market. Let's look at the fund flows picture. FIIs were mild buyers, very small buyers, just about 77 crores. Domestic institutions bought cash stocks, but less than 1,000 crores yesterday. In terms of what to watch today, I'll definitely watch out for financials. NBFCs first, because of the commentary that's coming from the finance minister. She met with a lot of NBFCs yesterday, and she said that they're systemically significant entities. They're no longer just shadow banks. And more importantly, the commentary was interesting with respect to, how NBFCs should be conducting their business in a fair and transparent manner. Also urging NBFCs to pass on the benefits of the lower cost of funds because of what the RBI has been doing. RBI has been cutting rates. So she says, I hope that NBFCs will be passing on the benefits. And then she said the push for growth should not come at the expense of customer well-being. So saying charges should be transparent, interest rates should be reasonable, quote unquote. So watch out for the NBFC space. And finally, this is our own CNBC-TV18 exclusive. Watch for PSU banks as well, because sources are indicating that via the QIP route, OFS and QIP, PSU banks could be raising almost 45,000 crores from the equity markets this year. And Bank of Maharashtra could be meeting the minimum public shareholding norms via a QIP. So there's some buzz around, perhaps some more PSU bank paper coming into the market. So financials on the radar for sure. Nigel?
Well, 3 top cues that I'm looking at. One is Trump and his continued letters that he's sending out, and he's maybe coming to the negotiation table, maybe not as well. So we'll keep an eye out on Trump's tariffs. The other one is Q1 earnings, which kickstart today with TCS reporting its numbers. So that's going to be an important cue. And the third factor, which is for the day itself, is the Nifty weekly expiry that will play out. Well, yesterday we ended a little bit lower, but it's not a cause of worry. I'll tell you why. Because, in fact, the VIX as well continues to cool off. With the kind of cues that you had, you expect the VIX to move up. But that, in fact, is hitting the lowest we've seen the last few months. So that's why I say that though we ended lower, we're still in the bit of a range, and I wouldn't be very, very worried. And you wanted some shots in the system? Well, your wishes come true because the shorts in the system got added yesterday by the FIs by close to 4,500 contracts. They remain net short with close to 72% of their positions on the short side. But if I look at both the participants, that's the FIs as well as the clients, and the data point comes up for you on the screen, both of them wrote more calls than puts. And that's telling you that the call writing is becoming a little bit too easy. And this, mind you, there'll be some kind of hedging as well out here. But keep in mind, when there is a lot of call writing, there are shorts in the system as well. You need some kind of positive trigger that'll push the markets higher as well, which could be actually a positive to see shorts getting into the system. Two strikes that were active, the 25,700 call, well, that was fairly active. But on the downside, the 25,400 put, well, that was active in yesterday's trading session. So just looking at the recent trading action, it brings us to the range that we're looking at with regard to the options data as well. So since that 25,400 put did see a fair bit of addition, there's a premium of around 40 rupees. In terms of a support, I'm looking at this 25,360. as well as this 25,420. That's the range I'm looking at. 25,420 because the last couple of days we've gone to those levels and we have bounced off that mark. And on the upside, 25,550 is the level that I'm looking at the upside. Why is this level? Let's pull up the next plate. The last 2 days, the highs as well as the lows are almost identical. So that should be the broad range you're looking at. The 25,550 on the upside, on the downside, 25,360 or thereabouts. That could be the range for the day. Well, in terms of stocks that I'm looking at, Reliance Industries. The stock did pull back yesterday in the final hour of trade. But remember, if the market needs to move up from here, this one will need to lead the way. And it continues to hold above that 20 DMA, which comes in at around 1,480. So Reliance Industries, this one, if it can protect that 20 DMA, I'm expecting this one to continue to lead the way from here on. It's been the outperformer for the last 6 months, and that could do the heavy lifting. The other stock that I'm looking at, from the broader markets, you want to buy into stocks that are seeing good amount of delivery-based buying, price action as well. And India Shelter, we had some fund-based buying the previous trading session. Yesterday as well, delivery was fairly high, and the stock made a fresh 52-week high. The stock's already had a good run, but I think this one, in fact, it's looking quite interesting, going by the price action, going by the kind of volumes that we've seen. So I'll keep an eye out on this one for the next few months as well.
Okay, absolutely. And thanks for mentioning TCS as well, because that's the big event. I mean, earnings season is officially kicking off. And by the way, TCS is expected to report a decline in constant currency revenue, 1.4% decline. So may not be the hottest of quarters, but we'll see. Let's then take it off with the equity call of the morning. Vikas Jain of CLSA expects first quarter FY26 pre-exceptional profit before tax for the India coverage universe, excluding state-owned oil and gas, to be up a meager 3% year-on-year. But a huge jump in profits of state-owned oil and gas names could push up the headline growth to 10% year-on-year. He says telecom, cement, capital goods and private oil and gas are the other areas that could report strong year-on-year improvement in earnings. However, he adds most large sectors will likely see weak quarter, with autos, financials and metals poised to register declines of 2 to 15% growth, while he expects growth for pharma, IT, property and staples to be subdued in high single digits. He says Nifty has been downgraded by 3% both for FY26 and FY27 in the past 3 months.
Jahangir Aziz is now with us. He's head of emerging market economic research at JP Morgan. Jahangir, great to have you with us here. Thank you very much. I want to start with what many our viewers are waiting for, which is the India-US deal. First in line to get a deal, that was the chorus. If you remember, we've spoken about this in the past. But now, of course, the deadline has come and gone, the so-called self-imposed deadline. But we don't have anything yet. But we don't have a letter as well. So naturally, negotiations are going on and it's going to be back and forth. But what is your sense? Seems like it's not such an easy, clear path. And we're talking about a limited 2-page document kind of deal, like an agreement. Go on.
Look, I mean, there are 2 ways, Prashant, to look at this. One is that the fact that India hasn't received a letter means that the US is taking India's views seriously, and they are actually being forced to look at the details and the nitty-gritty and the granular nature of a trade deal. Typically, trade deals take about 3 to 4 years, and trying to get it done in 3-4 months is asking a bit too much. But the fact that there's no letter the way in which was sent to Japan, which also went through a very protracted period of negotiations, or with Korea, is that this is being taken seriously by both sides, and so that's the positive way of looking at it. The other way of looking at it is that, look, one of the two sides is going to give up, and we are probably going to see a letter coming, if not this week, and then next week, because a conclusion or resolution has to be done, and the India trade negotiations can't be kept open. So that's the way I'm looking at it. That to me, at least it's a positive sign that people are actually, and both sides are looking at the granularity of what makes a trade deal.
Jahangir, hi, good morning. I mean, look at the markets. They've now stopped even reacting to trade deal news. So either the market is a genius, or it's missing something. Now we don't know. I mean, Brazil on one hand is 50%, but even large trading partners like South Korea are getting 25%, Japan getting 25%. Markets just not reacted at all. I mean, will these tariff numbers end up being a non-event, economically speaking, or the other reality could be that they'll eventually be negotiated down even lower? What's your sense?
So I think that, there has been, given the fact that there's been a lot of uncertainty around what the levels are, there's been a lot of pushing back on deadlines. There's been a lot of exemptions. If you look at, for example, the average tariff on Taiwan, it's very, very high. If you look at the effective rate on Taiwan, it's actually very, very low, simply because there's been a massive amount of exemptions. Almost 80% of Taiwan's exports, which are semiconductors, is exempted from those things. So given all of these exemptions, given the pushing of the deadline, given that deadlines have come and gone and have been extended, I think there has been a sense in the market, and, based on this, sort of movements, it's not unjustified that, at the end of the day, the bark is louder than the bite. But at the same time, we do know that US has been paying a significant amount of tariffs over the last 2 months. The May tariff collection was almost $25 billion. Just for that month. The previous month, I think, was about $19 or $20 billion, somewhere in that range. So people are paying tariffs on the imported goods. And so far, most of that tariff, increases have not really been passed on to consumers. Companies have actually taken that on their margins. And the key question is that, are they taking that on their margins because they don't want to lose market share? Or are they taking on their margins because the consumer demand is so soft that they aren't able to pass on the price increases without losing their own customer base? And so far, we don't have enough data to make that call. But clearly, this is going to will affect the real economy. And it's just that it's been delayed. It's been delayed because of the massive front loading that has taken place in the US. And this week is the start of the earnings season, and we shall see how most of these companies' earnings behave and what guidance they give on their earnings going forward.
Hi, Jahangir. Good morning. Good to see you. What about, besides Trump's tariffs, the other interesting data point that we get on a day-to-day basis is his attacks on Powell, forcing him that you need to go ahead and cut some rates. We had the FOMC minutes that came in yesterday.
Yep.
What do you make of it? And in terms of a rate cut, will you rule out completely that we get one in July? Because there was some kind of hint, some kind of expectation, but maybe that's too optimistic. Your take.
Look, I mean, at least the FOMC and the chair has taken a very, consistent stance, right? That they want to see the impact of the tariffs go through the price level, and that hasn't happened as yet. But they do expect, as so do we, that the impact of the tariffs will get passed on to prices first, and then the impact of that on the labor market. And before they see that, they are uncomfortable changing the interest rate. And I think that's our view too. And I think that consistency, will prevail. I think in July, which is about 2 weeks from now, end of July, I think it's way too early. Just look at the non-farm payroll. The headline numbers is 147,000. That has been, significantly higher than what the market had expected. The private payroll was down to 74, but it wasn't down to a level, 74,000. It wasn't down to a level that would create panic. So I think people meaning the FOMC will want to see the actual data showing signs. Either the labor market is slowing down more than they expect, or things are moving into inflation, and neither of those two things have happened. So I don't think that the Fed is going to move till they see that. And in our view, we don't think the first rate cut comes any before December.
Jahangir, so that's on the rate cut front, and let's see where when they finally pull the trigger. The other thing is, again, I'm going back to that question of why the markets are not too bothered with all these, tariff announcements and the letters as of now. The other narrative that's building in is that the US is going to be collecting a huge amount of money through the tariffs. Mm-hmm. Mr. Besson said that $300 billion are coming this year, and there are bigger estimates. Some commentators are saying that the tariffs alone could wipe out the budget deficit and this big, beautiful bill deficit over a decade. I mean, I don't know. Does that narrative make sense to you? And could that be a reason why the market is not too negative on tariffs suddenly?
No, I don't think so. I think most of the people in the bond market have a fairly decent idea of how much has been the increase in the deficit, which has been significant compared to what was being expected, back in before November, where the 2017 TCJA tax cuts would only be partially expended, not even fully extended. We've had that and more, and the spending cuts have been significantly less than what is required. So the overall budget deficit, most analysts would say that is now looking for a 7% average for the next 10 years. So that's a massive increase and a sustained massive increase in budget deficit. And this includes people's views about what the tariffs are. I think if you just look at, as I just mentioned, $24 billion coming into May. If you just take that and multiply by 12 and say, okay, you're going to get, ridiculously high numbers of revenue. That is only true if, all of these tariff increases does not change people's behavior in reducing the amount of imports. And let's not forget that the reason as to why we're seeing this very large tariff collection is because there's been a massive amount of front-loading, both in the first quarter as well as in April and in May, by U.S. importers of both intermediate goods and final consumers, because they are really afraid as to where tariffs will eventually land, and they want to build up the inventories before that. So I don't think you can look at these numbers and say, this is going to be life forever.
Yeah, no, absolutely. I remember this conversation with Jim Rogers. Not Jim Rogers.
Jim O'Neill? Did you speak to Mr. O'Neill recently?
It was Mark
Mobius.
Mark Mobius. He was the only guy who, so far I've spoken to, Jahangir, just an anecdote. He's the only guy so far I've spoken to with who actually really, and he's believed it since the beginning, that he really believes that this will be stimulative, if anything. So goods imports are about $3.5 trillion. 10%, they'll collect $300 billion into 10 years, $3 trillion. I mean, the math goes on, right? And of course, but I take your point completely, and we'll continue this conversation, Jahangir. Thank you for joining us, though, just running into other stuff as well. But really appreciate you coming on. And appreciate it. Well, we'll take a quick commercial break here. We're going to come back in just a bit from now. More interactions lined up on the other side. 8:30, we'll have Deepan Mehta of Elixir Equities joining us. At 9 o'clock, you'll have Rakesh Arora of Go India Stocks to talk about the metal sector. 9:10, Gautam Trivedi of Nepean Capital talking market stocks. 9:30, you'll have a discussion on textiles coming up, right? I mean, that's the labor-intensive sector. And of course, lots of listed representation there. Latika Kundu of Metropolitan Stock Exchange will be talking to us. That's the third stock exchange coming through. And of course, she'll be in the studios today. 9:50, Harsh Binani and Nitesh Sarda of SmartWorks co-working spaces, the new IPO, which is coming up. And towards the end of the program, it's the economy. Latha in conversation with Saurabh Mukherjee of Marcellus Investment Managers.
Time to slip into a quick break. A lot of stock-specific action to track. We'll get to that in just a bit in our special Top 10 segment. We're looking at IDBI Bank, IRDA, Asian Paints, MCure Pharma, NIT Learning, Titagarh Rail, Amber Enterprises, and Enviro Infra Engineers. All of them will be reacting to positive news flow, while LIC and Embassy REITs will be reacting to negative news flow. Slip into that break, come back. We'll get into all these stocks in further detail.
Welcome back. So as we've been telling you, Asian markets are holding up rather well, barring Japan. Now, the other major markets are actually positive. The Hang Seng is up about 40, 50 odd points. Ditto for Singapore and many of the other regional markets as well. Let's look at the implied open. It was absolutely flat when we checked it last. It was hardly sort of 1-2 points up or down. Yeah, that's the GIFT Nifty, 25 points lower, about 10 lower on the implied open for the Nifty. Let's talk about individual stocks, because there's several of them that we need to watch out for. And our team is standing by with the CNBC-TV18 list of top stocks of the day. Guys, good morning to all of you. Let's start first with the news that Sapna, our colleague, picked up on IDBI Bank and perhaps LIC as well. Sapna, what's the government's view?
Well, what we have understood is that the intention here is to wrap up the IDBI Bank stake sale as early as October. Now, this is the intention of the government, and the sense we got is that they have kind of fast-tracked the process, and they seem to be in a hurry. However, what needs to be also kept in mind is that as of now, the core group of secretaries and the alternate mechanism headed by the finance minister, the approvals will be required for the SPA, which has been just frozen by the IMG in the last meeting. So that is one process. Plus, after this, the government will call for financial bids. So, post that also, the bidders themselves will need a window to kind of put in their bids. So October is what the government is looking at, but I think at best by the calendar year, this should be in the bag. That's one. Second, the in-principle approval for the LIC OFS is in place. We are aware of the fact that on June 17, there was again an IMG meeting on that front. Now, it remains to be seen what the timing will be, how much of issuance the government wants to do, what is the intention behind that. So that's the second one. Third, and this again we have been hearing since a very long time, so four public sector banks, UCO, Central, Punjab and Sindh Bank and IOB, they will have to do an OFS probably by the last quarter of the current financial. Government is preparing the ground for that. I think the merchant bankers for the issuances will be appointed very soon by DIPAM. Bank of Maharashtra may not be a part of that because they're already meeting the 25% public float norm through QIP. So this is what is there as of now. However, you also need to keep in mind that the MPS requirement for the 4 PSBs will be in tranches, and hence the MPS deadline of August 2026. So that will have to be extended at least by another year.
Okay, all right. Thanks a lot for that, Sapna. Well, let's hop across to Gaurav. He's here to tell us about IRDA. Morning, Gaurav.
Well, yes, there are two triggers for IRDA, and first let's talk about the latest one. Now, government has now allowed IRDA to raise funds via 54 EC bonds. Now, these bonds are also known as capital gain bonds. Why this is important is that via these instruments, IRDA can raise funds at a rate as low as 5.25%. Now, these discussions have been going on since early 2024, and there are 5 more companies who are currently raising the bonds via these instruments, which are REC, NHAI, PFC, IRFC, and HUDCO. Now, this is actually important for cost of funds angle for IRDA, because when we look at the cost of fund in FY25, that was at around 7.6%. It was already lower, almost by 20 basis point on a year-on-year basis, and we may see some further easing on the cost of funds. Let's also not forget that IRDA will also come up with their Q1 results today, and they have already seen a strong update from company where we saw loan book growth at around 30% on a year-on-year basis, and disbursement growth was also strong. So definitely two triggers for IRDA, and on the back of this, we are watching this company today.
Okay, all right, got it. Thanks very much for that, Gaurav. So IRDA is going to be on our radar for sure. Vivek is joining in. Embassy REIT in focus. We saw some deals. We're expecting some deals perhaps on this one. Vivek, morning. Tell us more.
Good morning. That's right. So Embassy REIT, the Real Estate Investment Trust, is in focus. We accessed the term sheet last evening. So what we understand is that a Bain Capital or a Bain company affiliate known as APAC is looking to sell close to 1.9% of the total units of the company via a block deal today. The offer size, remember, will be slightly upwards of 680 crore, and the offer price is at 382 rupees a unit, which is at a slight discount to yesterday's close. Watch out for Embassy REIT. Remember, these stocks are not very, very volatile, but today you could see some red on the back of this particular block that is coming at a discount.
All right, Vivek, thank you very much for that. Let's talk about more stocks with news flow. Vinny is here with details. Vinny, good morning.
Hi, good morning. So starting with Asian Paints, we're expecting a bit of a coat of green coming in for the company. They've sold their entire stake of 4.42% in AkzoNobel, and this is around 734 crores of the stake that they've sold. The price of this is important because 3,651 rupees per share is what they've sold it at. And do not forget, AkzoNobel's open offer price when JSW Paints had acquired the company, that was at around 3,417 rupees per share. So obviously it's a premium versus the offer price as well. Asian Paints had bought the stake around in 2017 from, in the company, 4.3% stake. So now finally they're seeing a bit of an exit coming in here, and obviously it's doubling its value over there. Emcure Pharma, that's the next one we're keeping an eye out on. Its Ahmedabad facility has cleared the US FDA inspection without any observation, so positive there. The inspection was carried out between 30th of June to 8th of July, and this is an oncology manufacturing facility, so important there. NIIT Learning, that's the next one we're keeping an eye out on. Its wholly owned subsidiary has acquired MST Group, which is based in Germany. This will expand their managed learning service portfolio in Europe, expand their further reach in Europe as well in terms of quick start learning academics, as well as marquee customers come in on that front as well in the automotive industrial sectors as well. Now, lastly, we have Titagarh Rail that's in focus. We're expecting green here as well. They've raised money by issuing around 21 lakh warrants to the promoters. This is for around 945 rupees per share. And obviously, this will amount to an aggregate warrant is coming up to around 200 crores. To promoters, that is Rashmi Chaudhary as well as Pritesh Chaudhary. So important to watch out for promoters increasing almost somewhat their confidence in the company.
Okay, yeah, promoters, buying more is always taken well by the market. Thanks very much for that, Vinny. Let's get to Vamakshi. She's watching out for a couple of names as well this morning. Vamakshi, good morning.
Good morning, Survi. Let me first start off with Amber Enterprises, going with the green for this counter because the board meeting is scheduled on July 12th. They will be considering a fundraising plan. Now, they will be deliberating on raising funds up to 2,500 crores. Now, just to give our viewers some context, keep in mind that the company is entering the HDI PCB, which is the high density interconnect printed circuit board manufacturing through a JV with Korea Circuit. Now keep in mind they're also scaling up accent circuits capacity. So therefore the electronics vertical for Amber Enterprises has outlined a capex plan of almost 2,500 crores over the next 5 years. Keep in mind that out of this around 1,000 crores will be incurred till FY27 itself, and there is a time gap between the capex investments as well as the government subsidies, and therefore to bridge this gap the company may raise funds, and this is something that the company had indicated in the conference call as well, and it has come through. The board will be considering fundraising on July 12th. The next stock that I'm watching out for is Enviro Infra, green for this one as well, and that is because the company's JV with Altora Pro Infra, where Enviro is a lead member, has received an LOI from Maharashtra Industrial Development Corporation, and this is worth almost 396 crores, bodes well for the company.
All right. Thank you very much for that, Vamakshi. Here's a quick recap of our top stocks that we have on the radar as markets open. IDBI Bank, IREDA, Asian Paints, Emcure Pharma, NIIT Learning, Titagarh Rail, Amber Enterprises and Enviro Infra Engineers in the green, while stocks on the negative side are LIC and Embassy REIT.
Well, time to slip into a short break, but on the other side, we'll get an exclusive conversation going with Mr. Gabriel, the co-founder of Viceroy Research, to talk about their report on Vedanta Resources and Vedanta Limited. Stay with us. Well, Viceroy has come out with a report describing Vedanta Resources as a parasite and Vedanta Limited as a dying host, while Vedanta has hit back stating that the sole objective of Viceroy Research report is creating a false propaganda. Well, let's go across to Mr. Gabriel, the co-founder at Visor Research, who joins us on the show. Hi, Gabriel. Good morning, and thanks a lot for joining in. Well, a couple of questions first before we start off the discussion. What's the current position of y'all on, on Vedanta Resources or Vedanta Limited? We could clear the air on that first.
Sure. Per the first line of our report, we're short the debt of Vedanta Resources, which is the parent company and controlling entity of Vedanta Limited.
Got it. And no position on Vedanta Limited?
No.
Got that. All right. So that's out of the way. Now, the timing of this report is interesting, right, Gabriel? Because all these data points from Vedanta Limited, Vedanta Resources, they were already known. So the question is, why exactly did you choose this sort of a time? One would say that the demerger is in the offing, and that's why, in fact, could be a bit of a span in the works. Explain to us the timing.
Well, I think, this has been the talk of the town for quite some time. But, to address what has already been known, if it has already been known that, ESL Steel is engaging in CapEx fraud, or that Vedanta Limited are hiding tens of billions of dollars of contingent liabilities and fake asset values, and the auditors are not fit for purpose, or, that the balance sheet is propped up by impaired assets. And, I guess that says more about the analysts, who are still promoting the stock to their clients. As for the timing, this timing has occurred simply because we received the annual report only a few weeks ago. We've updated our research to fit that FI 2025 report, and we've released it as soon as we could. This has been a few months in the work.
All right, you made various allegations in that report and have gone through that. But, Gabriel, as you said, various analysts still believe that the stock is attractive. Various research reports, they say that the stock is trading at less than 5 times EV on EBITDA. So they believe that it's attractive. But you have a different view. Right. My question to you is, all eyes on the demerger, and people believe that if the regulators give a go-ahead, there'll be big value unlocking on the demerger. But you believe no? Tell us why.
Well, we've gone through every operating subsidiary and their financial accounts individually. And if this demerger does occur, what will happen is you will be left with, substantially non-operating subsidiaries or financially unsustainable subsidiaries laden with debt that won't be able to support themselves. We don't see why any stakeholder would prefer this to the current, barely sustainable model that currently exists. And we don't see how this can unlock any value because these assets that will be spun off are inherently unprofitable.
Gabriel, hi, good morning.
Morning.
Would it be possible for you to disclose the size of your short position on Vedanta Resources debt?
No, we're not going to disclose that.
Okay, but is it a short position that only you have built? Or are there other investors that have built this position along with you?
We're not going to disclose the how we engage
the details
of your short.
Okay, it was just report. All right, that's all right. It was just my job to ask.
No, it's okay.
Coming back to the report, you obviously cite the ballooning debt or the growing debt at Vedanta Resources, and you're saying it's a parasite, it's a zombie entity. So I just want to ask about the debt itself, because the group actually has been reducing its debt. It's known that they've been, holding on to very large amounts of debt. But as our data, throws up from a debt of almost $9 billion, that number has come down to less than $5 billion as of March 2025. So again, you're not looking at that at all, the promoter intent of deleveraging, because that's been stated public intent of the promoters.
Correct. We have looked at the net debt of the group, and we have looked at the net debt of Vedanta Limited by itself and of Vedanta Resources. It is true that Vedanta Resources has reduced its debt. The group on a net basis has not. The reason that the gross debt is falling is because of rampant asset sales, a diminishing cash position, and effective working capital management. These are one-trick ponies that the company does not have access to anymore. It cannot raise more debt. It cannot sell any more assets. It doesn't have as large of a cash position as it had before. It has no working capital to manage to unlock that value, and it's basically levered to the hilt.
Gabriel, if you had come out with this report, I think a couple of years ago, they were in far worse state than what it is today. But nonetheless, you believe even at current reckoning, you mentioned in your report, in fact, that the structure is fundamentally broken and headed for disorderly collapse. But I'm looking at a couple of global ratings agencies like S&P, Moody's. They went ahead and they upgraded Vedanta Resources, in the last 12 months or so. Are you hinting at a default at Vedanta Resources or Vedanta Limited? If yes, by when are you factoring that to come about?
Well, let's go back one step before this. 2 years ago, Vedanta Limited was in a far better position in the sense that its interest payments were substantially lower. The effective interest rate has almost doubled since 2022, meaning that although you can look at the debt whichever way you like, the free cash flow that supports interest payments has taken a massive hit because the cost of this debt has exploded, and we don't, we don't go to ratings agencies for our research, and we don't rely on that for our research. We conduct our own research. Most of our research, historically, and our track record has been to stress test qualitative aspects of businesses in a much more thorough, methodological way than ratings agencies or other analysts.
That's great.
And it's proven to work time after time.
That's great, Gabriel, and good on y'all. But I just want to know, you believe that this is like a ticking bomb, right? By when do you expect a default at Vedanta Resources, Vedanta Limited? We have had Mr. Anil Agarwal on the channel a few months ago or so, and he continues to make this point that they will not default, and he's very, very confident about it. But you don't believe so. So tell us.
As it stands, Vedanta Resources, Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an event of default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt, that's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research, and we think that the end result is a disorderly collapse.
But Gabriel, are you expecting a default from Vedanta Resources anytime in the near future?
Yes, we are. We believe the best, and we've written this, we believe the best outcome for the stakeholders of Vedanta Limited, that includes the creditors of Vedanta Resources, because their collateral is basically the equity in Vedanta Limited. We believe the best outcome is to take this business away from a group that is effectively pillaging this business for its own needs. Vedanta is run by a majority shareholder for their exclusive benefit. It doesn't align with the goals of minority shareholders.
Vedanta, in their statement yesterday, also said that you didn't make any attempt to reach out to them. Typically, when analysts write on companies, they want to ask hard questions to the management. But Viceroy Research didn't feel it proper to do so?
No, we don't engage with management. We believe every information that the shareholders should know is available online. And, given what we have uncovered, it's clear to us that we believe that they're habitually untruthful.
Gabriel, I'll tell you what, as you're saying that Vedanta Resources has been draining Vedanta Limited of all the cash, everything's for the benefit of Vedanta Resources. I'll tell you what, there was some feedback that came in from shareholders yesterday. They are very happy because the kind of dividends that they've got in the last few years could have been as much as the share price, say 3 years or so ago. So they said, they don't see it's a big concern. But as you're stating, for you, it's a concern because you're saying that, in fact, it's getting totally squeezed out. I get that point. So it's different ways of looking at it. But shareholders, I'll tell you what, some of them are quite happy because the shareholders have been gaining as much as what, the Vedanta Resources promoter as well has been gaining. That said, have you been contacted by Vedanta Limited, either the regulators here in India or anyone else? Have you had any kind of conversations?
We obviously send our work to the regulators, and we submit that to the regulators in every job we do. But we haven't heard from Vedanta, no.
Mm-hmm. As of now, you mentioned Viceroy hasn't taken any positions on Vedanta, the Indian listed entity. Do you have a view on the Indian entity? Do you find that to be absolutely sound otherwise?
No, we think that Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated. We believe that the company has revalued substantial assets, billions of assets, at unreasonably high levels, and have borrowed.
Okay, let me just restate that for our viewers, just so that we know your position clearly. You're saying that assets held under Vedanta Limited, the Indian listed entity, are overstated. Is that what you're saying?
Yes.
To what extent? I mean, some rough back of the envelope estimates?
Billions, multiple billions of dollars.
Okay. Oh, okay.
All right, Gabriel, final question before we let you go. Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
You'll have more in store. All right. Is it only Vedanta or any other Indian listed companies you're looking at?
No, I might need a break after this one.
Got it. All right, we've heard your side of the story, Gabriel. Thanks a lot for joining in. Appreciate it. And we look forward to chatting up with you in the time to come as well. You know, the evidence that we have from Vedanta's presentation suggests that their debt has been coming down in Vedanta Limited, Vedanta Resources as well. But you believe that, you know, things are coming to a bit of a dicey situation for the company. We'll see how that goes. And as you mentioned, you're expecting them to default as well. Vedanta Resources debt comes up for you on the screen. Vedanta Limited as well. If you look at it on a net debt to EBITDA basis as well, it's come down drastically to around 1.2 or thereabouts from around 3 in the past. Well, that's it. Let's slip into a short break. On the other side, we have Deepan Mehta of Lexar Equities who joins us for some fundamental stock talk.
Back, we got the market, which of course is the GIFT Nifty is not doing very much. It's actually absolutely flat, but maybe a little bit more. When we started at 8, was down about 3 or 4 points. We're down about 25, 26 points. Deepan Mehta, director at Elixir Equities, is with us to run us through what he's making of things. Deepan, good to have you back on the program. Thanks very much. Things have gone to sleep in a way, right, as far as markets go, except day before yesterday, that sensex expiry, we had a bit of a pop in the last half hour, but otherwise sideways, ranged, and very, very quiet out there, Deepan. And actually, why not? Because you don't have really that many triggers or anything, right? Earnings are going to start to come in, and generally what we pick up in terms of expectations and otherwise is it's going to be a pretty muted set once again.
Yeah, Prashant, good morning. I think you have answered your own question. And I'm also thinking that it's fine if the market is in this position. Only thing you need to add over here is the Trump tariffs and how that will play out for India, because that's one big uncertainty. And hopefully over the next few weeks or so, we'll be over and done with that as well. And I completely agree with you that this quarter may be a bit dicey. The pre-releases have not been that great and valuations are still quite expensive. So the way I look at the picture here is that for the markets to move up higher, like if you want a 5-10% type of up move in the Nifty, that will not happen unless we have a clear-cut, kind of vision that the earnings are going to go to the next level. At 4.5% type of earnings growth for Nifty, it's not going to move the needle too much. There are downside risks if there's any adverse development on the Trump tariff side. So I think one needs to be a bit cautious at this point of time. And then, of course, during earnings season, there's a lot of stock-specific volatility.
Deepan, hi. Good morning. I don't know if you caught some of our conversation with Viceroy Research just now. Vedanta is the new talk in town, right? Just for shareholders, I mean, shareholders could be very confused, wondering what, because they were perhaps waiting patiently for the demerger to go through, value unlocking, as Mr. Agarwal says. Now comes this research report. What would your advice be?
Yes, good morning. First, a disclosure that we are invested in Vedanta. And I think that the market clearly has given the response over here. There was hardly any movement. There was a knee-jerk reaction, but a lot of lost ground was covered over there. I still feel that our regulatory bodies are strong enough to detect any kind of overstatement of assets, if at all there are. And of course, Vedanta has got a very good set of auditors as well. There may be issues with the holding company, but then Indian shareholders are not really concerned with that per se. And the management have been making drastic efforts to reduce debt, and that certainly has been reflecting in the sentiment in the stock and the recent appreciation which we have seen. And end of the day, I think there are some great assets, be it in copper, aluminium, and zinc. And whenever the commodity cycle starts to move up, this could be one big money-making machine. And now even silver prices have moved up, so that's very positive for Hindustan Zinc as well. So I'm not too concerned about this report, and I would remain invested. And of course, whenever the value unlocking does take place, you can easily get a pop on the total investment which we have made in the consolidated entity.
Interesting times, Dipan. If this report came out a few years ago, a couple of years, I think September 2023, if I remember correctly, that time the position was very, very, feeble. Now, in fact, they've done quite a bit, actually, though the stock still trades at valuations of less than 5 times EV on EBITDA. But one would argue you don't know what the promoter will do next. So rightfully so. But as you said, the assets are good. I think there's a ramp up of a lot of assets. H2 of FY26 could be one of their best for them. So let's see how that goes. And let's see whether regulators give them a green signal to NCLT. I think for the time being, maybe the street could look past this report from Viceroy. That said, let's talk about the big boy, Reliance Industries. It saw a bit of a downtake in the final hour of trade yesterday. What's your view out there? Because in the last 6 months, it's been in splendid form after underperforming the prior 6 months.
Yeah, Nigel, good morning. Bit confusing in Reliance because, you're buying into so many businesses. And I've always maintained that the real kicker will come in Reliance when they kind of, unlock the value over there. And whether Reliance becomes a holding company or you get, kind of a split entity where you get the separate shares of each of the businesses which are there. And that's the key driver. I mean, stock prices can go up and down because of various reasons. And Reliance has done well because maybe investors expect improvement as far as the refinery business is concerned. But for me, I think investing in Reliance is like buying so many businesses. Whereas as an investor, I'm interested only in one or two of the entities or one or two of the subsidiaries. And there's no way to get a complete play on those subsidiaries through Reliance Industries itself because there could be other underperforming segments within the company as well. So that's a bit of a confusing thing. But anyway, look, remain invested in Reliance Industries and hope that the management takes the right decision when it comes to value unlocking.
All right. Let's take a quick commercial break here. Deepan, of course, is with us. We'll come back. We'll have Sudarshan Sukhani and Mitesh Thakkar join in with some technical trading ideas. That's coming up. We'll also have Rakesh Arora of Go India Stocks to talk to us about the key trends in the metal space. I think we'll touch upon Vedanta with him as well. Stay tuned.
Welcome back. We'll start getting pre-open rates in about 5 minutes. So let's quickly go to our technical experts and get a sense of how you can prepare for the day. Sudarshan Sukhani and Mitesh Thakkar are with us. Gentlemen, hi. Good morning to both of you. Sudarshan, let me open with you. I remember we were discussing this yesterday. You were saying that the range should break, soon enough. But yesterday was more on the downside than the upside. What are your index calls for the day?
Yeah, good morning. Yes, and now we are on the verge of that lower end of that small range. So for all we know, it could break on the downside. Since I'm not very keen to suggest taking short positions, the view remains that this market is not bullish as of now, and the best trade is to step aside. For savvy, smart, say professional traders, you could consider short positions with a stop above 25,550. Otherwise, stay away.
Okay.
Got that. Gentlemen, morning. Sudarshan and Mitesh. Mitesh, what about you?
So, Good morning, Prashant. I've been maintaining that this market is showing signals of contraction, and I think that view continues. Broadly, it's a 25,200, 25,650 kind of a range. And like many days in the past few days, I maintain that this range will be in force for forcing future, 5 to 7 days at least, because most of the volatility indicators are shrinking. So broadly, try to buy the index once we approach the lower end of the range. Otherwise, avoid and trade with stock-specific biases.
Okay. All right, gentlemen, let's talk about stocks as well then. Mitesh, what about you? What stocks are you going with today?
Yeah. Good morning, Surbi. I have a mix of buys and sells. On the buying side is Container Corporation with a stop at 603 for targets of 640, and Bazaar is a buy with a stop at 2004 for targets of 2070. And on the selling side, after a big rally, Solar Industries is showing first signs of profit booking. So sell here with a stop at 16,650 for targets of 16,100, and MCX similarly is the sell with a stop at 84.90 for targets of 82.60.
All right, got that, Mitesh. Thanks so much. Sudarshan, what about you? What stocks are you looking at?
It's a mixed bag today. M&M is a buy with a stop under 3,095. GMR Airports is a buying opportunity. It's also a positional buy with a stop under 89. I have two intraday shorts, JSL, Jindal Stainless, stop above 698, and RVNL, which is Rail Vikas Nigam. It's a intraday short with a stop above 394. As usual, if you're looking for short positions, be very careful.
Okay, all right. So tread with caution, keep those stop losses tight. Thanks for that, gentlemen. We'll come back to you closer to market opening. Deepan is still with us. Deepan, it's a TCS day. Earnings season is kicking off. And I know we've discussed this for a long time, that, growth is elusive and all of that. But sometimes, they become trading opportunities, these IT stocks, if nothing else. What are your thoughts? I mean, doing anything before the IT earnings season at all, either with TCS or any other company?
You're right, Surbi. It's a trading opportunity. Even when you are bearish on a sector, there can always be surprises because the street has an expectation. And if the company reports numbers beyond expectation, look, a 5-10% up move certainly can take place, and similarly the other way around as well. But either you focus on such trading opportunities or you focus on great long-term stock ideas. And I think that entire Indian IT services industry, the traditional ones, they are out of steam completely. They are secularly, I think, in a stagnation mode. And last 5 years certainly have been not that great in terms of returns or profitability. And I don't know anything which may change and take them to the next growth trajectory. So I think from our point of view, it's an avoid.
Got it. All right, Deepan, India Shelter, do you track that one? That's the one that saw some fund-based buying 2 sessions ago. And yesterday as well, it moved at very, very good volumes. Have you looked at this name?
I did many months ago, but I like the basic business model. They are an aggressive home finance company and focusing on the underbanked or the lower end of the segment over there. And that's always positive. And they have a decent track record when it comes to collection. Because when you are, focusing on that segment, the mass market, the lower middle income, your collection strategies are to be extremely strong. And I think they seem to have achieved that. Reasonable valuations as well, I feel. And of course, we are very positive on NBFCs because I think their cost of funding certainly will go down. And that should improve the net interest margins. And in a way, I think companies like India Shelter, and there are others in the space as well, have a good runway for growth because of limited competition per se.
Yeah, absolutely. What we're going to do is we'll just bring in one more name, right? Actually, one more space. We spoke with Digant Haria on NBFCs yesterday. Let's talk about the NBFC space, but housing finance in particular. Bernstein has got sort of a note this morning out. Gaurav is here with the details of what they're saying. Gaurav, good morning.
Well, yes, many companies from housing finance space are in focus, and the reason being that Bernstein has now initiated a report on these companies. First, let's talk about the housing finance companies in the like of Home First Finance, where they have outperform rating. They also have outperform rating on Aptis and Aadhaar. For Home First Finance, what they're saying is that the company actually stands out well in terms of the overall space, and at the same time, they also like the business model because it is growing at a faster pace. Other than that, for Aptis, what they're saying is that the company has high share in the fixed rate loans, which is actually helping the company, specifically in a time zone where we are getting the interest rate cuts. And for Aadhar Housing Finance, what they're liking is that it is actually largest and most geographically diversified player, and that is the reason why they are actually maintaining or rather initiating with their outperform rating. On the other hand, they have initiated on Aavas and PNB Housing with market perform rating. For Aavas, what they're saying is that it is actually lagging its peers in terms of yields and profitability. And on the other hand, for PNB Housing, what they're saying is that the shift towards small ticket size is actually good. But on the other hand, there are some concerns about the business, and that is the reason for now they have kept the market perform rating. So definitely on the back of the positive note coming up from Bernstein on the housing finance companies, we are watching out for all these companies today.
Got it. Okay, all right, Gaurav. Thanks a lot for that. Deepan, you want to come in on this report?
No, I think it's a good report, and we are also quite positive on the housing finance companies. And within the entire spectrum of NBFCs, housing finance perhaps is the safest segment. And these companies, I think, by focusing on the underbanked, the underprivileged segment, certainly have got an opportunity for growth. And all of these companies, I think, have great prospects so long as they're able to manage their collections and NPS better. And valuations also are reasonable. I think the track record last 4-5 years also been quite impressive. So I would say that if you're looking at increasing exposure to the banking sector, banking NBFC, these category of companies, the new generation, I would call them new generation housing finance companies, certainly can offer outperformance.
Got it. Okay, all right, Deepan. Appreciate you joining in. We look forward to having a chat with you, and have a good day ahead. Well, let's focus on the metal space. That's seeing some selling pressure yesterday. Trump announced some tariffs on copper, 50% on that. Q1 updates as well have started coming in. Let's discuss what's the call on metals. Rakesh Arora, founder at Go India Stocks, joins in on the show. Hi, Rakesh. Good morning. Good to see you. Let's start off with Mr. Anil Agarwal's stock, Vedanta. You have seen it for the last couple of decades, from I recall chatting with you about it more than 10 years ago. But what's the current stance on it? Viceroy's report is going, hard out at Vedanta. Vedanta says this is totally malicious reports. The timing of the report as well is the problem. What's your take?
So, Nigel, the playbook for the short sellers is very clear. Find companies with, shades of grey and who have high leverage. Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. So I think, the report raises some issues which were kind of well known, but the boat has already sailed and there's nothing left here to really, gain from short selling.
All right. In fact, when the co-founder of Viceroy joined us earlier today, that's what I had mentioned to him as well. Maybe 2 or 3 years back, this report would hold some ground. But actually going by the action we've seen on Vedanta Limited in terms of deleveraging, Vedanta Resources as well, cutting the debt by half, it appears a little bit late in the game, but they stick to their guns that Vedanta Resources will ultimately default. We'll see how that goes. That said, what's the view on the stock? At around 440 rupees, would you advise buying into it? Because we have the demerger that's in the works, and the stock trades, as we've been mentioning, 4.5 to around 5 times on FY26 EBITDA itself.
So, Nigel, I'll leave that for the investors to figure out. But what we can say is that Vedanta stock is largely dependent on aluminum outlook. Yes. And the aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. But valuation-wise, I'll leave it for investors to judge.
Got it. And that aluminum business will be bulk of their SOTP. Cost savings are going to be there on bauxite as well as coal and alumina, which they'll be getting, from their for backward integration. So we'll have to see how that goes. But you're sounding fairly optimistic on the stock. What about the metals pack on the whole? Yes.
One last question. Rakesh, hi, morning. Prashant here. Yeah. So many just to complete that loop on Vedanta before Nigel moves on to other areas, is there like a trigger here for Vedanta, which so many people, HNIs, everybody owns the stock, right? I mean, the value that clearly is there, but is there like a tipping point which will sort of unleash gains here, Rakesh, as you think about it?
I don't think this report really.
No. Forget the report. I'm not talking about the report. I'm saying, is there a? This has come now, as you said, 2 years late. I'm saying people have believed and bought this over the last 1.5, 2 years. The stock, that is. I'm saying, will it? Is there a point where it starts to do well and starts to give returns?
No. So Vedanta has been a fund. Has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here. So meaning that inflection point happened 2 years back. And now we are into a steady growth state. So, I don't think there's any inflection point we are waiting for. Obviously, this demerger and everything.
Rakesh, my point is stocks at 450, right? It was 450 in 2010 also. Now you can add all the dividends, etc. That is the real meat here. Is that what you're referring to? Of course, I mean, in terms of balance sheet, etc., there's been a lot of repair. You said $10 billion down to about $4-5 billion in debt. But I'm talking about price appreciation, stock-wise.
Yeah. So see, what has changed is aluminum outlook. Aluminum used to, be loss-making for them, and they were hardly producing anything. They were not integrated, and aluminum was trading at around $1,600-1,700 at that point in time. Now it is $2,600. So that $1,000 has changed the whole, situation for them. They have such a large capacity, and they had all these issues with Langiger, etc. They were not able to integrate, reduce their cost, but now those issues are getting resolved. So I think, we have come back to a point where things are looking really, really stable and strong from them from a fundamental point of view. So inflection has already happened, re-rating has happened, and now it is steady growth ahead.
Got it. All right. What about the Ferris pack? If you could tell us what is your top pick out there. Q1 could be a little bit subdued, but the remainder of the year is expected to pick up, right? If you're going to see a revival in construction, and we have that safeguard duty in place as well. So what do you like from there?
So, Nigel, near-term outlook is okay for steel stocks because steel prices have gone up and raw material prices have gone down. So there would be quarter-on-quarter margin expansion for steel companies by around 3,000 rupees per ton. So that's a big thing for them. From a medium-term perspective, things are not very clear. It will depend on what China does. There are indications that they might, cut production, but we have to wait and see because one can't be really too sure about, China's policies. So I think near-term is strong. Medium-term, I think it is neutral at the moment for ferrous stocks.
Okay. All right, Rakesh, great conversation. Thank you very much. We'll leave it on that note for this morning. Thanks so much for joining in. The market has settled in the pre-open session, and what we have is about a 35-point up move on the Nifty for the time being. Mid-cap index is flat. Bank Nifty is not too bad actually this morning, up about 0.25%. We have Gautam Trivedi, managing partner at Napency Capital, right here with us in the studios. Gautam, great to have you in.
Thank you.
So much the market has had to digest, from wars to trade wars to, short seller reports and, so on and so forth.
Yeah.
But, I want to then, the whole thing is regulatory action back home as well, this whole Jane Street saga. I want to start just right there to understand whether what we are seeing in the last few sessions, this last 1 week where the market's gone so quiet that the index barely moves 10 points in a day. Is it just a lull before earnings and further news flow? Or do you think that this overall Jane Street / HFT crackdown of sorts, whether that will have a part to play in just the near-term trading action?
Yeah, I think the impact of Jane Street seems to be limited more to the futures and options market, not so much the cash market. And if you look at I agree with you that the market's been sort of flattish for over about 10 days now or so. But I think earnings is really what's going to, people are waiting to see which way to drive the market from here on. Given earnings, given the fact that our first quarter earnings were actually pretty dismal, and if you drill down even further, I looked at the numbers actually last night. and I found that the fourth quarter consolidated the Nifty 50 numbers were actually still very, very weak. I mean, PAT growth, and again, I'm talking of consolidated because some people like to slice and dice by saying X financials, X OMCs.
X oil and gas.
Exactly. But if you look at a consolidated Nifty 50, PAT growth was a mere 0.8%, so less than 1% PAT growth. And even for the full year, FY25, the PAT growth was a mere 5.5%, which apparently is a 4-year low.
Yeah.
So given this, I think, on a short-term basis, given that the earnings season kicks off later this week into next week and then so on, I would wait to see what the numbers are before incrementally putting more money in the market.
The only thing is, I think we're going in with the season with fairly, solid expectations, because the mood in the market is that we've seen the trough and it just gets better from here. So, estimates ranging between 11% to some of the optimistic ones to 13% earnings growth this year. Do you think that'll play out?
It seems a little challenge at this point because we do start off the fiscal year every year for the last few decades with an extremely high, aggressive...
It's a ritual.
It's a ritual.
Start optimistic, always.
Optimistic, exactly.
Tradition means something, right?
Start on a hopeful note.
No, but having said that, I mean, I hope that the transmission of the 50 basis points repo rate cut starts to happen with the banks. September, we'll see the CRR cut, more money flooding the market. So hopefully all of that should play out and help the Indian economy.
Actually, the crazy thing is that every quarter, if you look at the expectations this quarter, they're very muted. But then if you look at year is made up of 4 quarters, right? Yeah. But if you look at the annual earnings growth, that is still, as you said, reasonably rosy. But quarterly, if you look at it, it's always very challenged and expected. I mean, look at, is there any sector, if you just look at this quarter, where you think we'll see very good earnings growth? Banks, 30% of the market, NIMs will fall this quarter, next quarter.
That's right.
IT will get hit. TCS. I mean, we're talking about CC decline. We're talking about the extent of the decline. 1.5% could it be larger?
Yeah.
FMCG.
Not happening. Yeah.
Low single digits, as they always.
Don't want to sound all dire in the morning.
Thanks, huh?
I think the earnings downgrades happening here right now in the studio itself. Let's not even wait for the analysts on the results.
But it's been like that, Gautam, right? I mean, there are obviously shining stars within each sector.
Yes.
I mean, for example, in IT, there is Coforge. So there is stuff which does well.
No, for that matter, in QSR, there's Jubilant, right?
Yeah.
Everything else seems to be either single digit or negative same-store sales growth, but Jubilant seems to buck the trend quarter after quarter. So, yeah, you're right. There are certain... even for that matter, let me put it in terms of the shoes category. If you look at Campus, you look at Bata, you look at Relaxo, all struggling. But then you have Metro, on the other hand, who's doing extremely well.
So I read wires and cables. They could do well this quarter. I don't know. Do you look at that space?
No, we do, of course. But again, that's probably having a moment like paints where you're seeing big players coming soon. Not yet, but coming soon, yeah. So that's starting to get discounted in the price.
You know, Gautam, since you mentioned Jubilant Foodworks, the report was very, very good, the quarterly update. But how much of it is in the price? That's the problem. Because on the day that they declared it, the stock actually ended down 3.5%. Yeah. And most sell-side reports that I saw suggested it was good. And even I went through the fine print, it looked pretty good. So your view on that? How much of some of this good news is already in the price?
Well, Jubilant's always been an expensive stock versus the others. So I'm not really concerned about the valuation.
You're still going to remain positive on it?
I would remain positive because it seems to be the only, shining light within the QSR space.
Okay, just coming to you, Gautam, we've got the market open. So we'll see if it's absolutely unchanged from yesterday or we've got something going here. No, it's actually 20 points, so 25.
See how excited Prashant is. 20 points on the open.
Better than 2 points. 20 points on the Nifty. Sensex is... It's like we started day before yesterday. Massive 2 points.
Massive 2 point change, yeah.
Well, 85 points on the Sensex. 83,600 is where the Sensex is at. The Bank Nifty is up 80 points, 85 points. The Nifty Mid-Cap Index is up about 40-odd points or so. So it is what it is. Actually, yesterday, everything was slightly on this... it was not sliding or anything, but it was down to sideways, except the small-cap index, which ended with about a 0.5% odd gain yesterday. And that is, of course, thanks to some individual names there. A broader, the Nifty heat map, as you can see on your screen, 35, 36 names are up, and the rest of the stocks are actually lower as we begin this session. I can spot pharma, and I can spot some IT there, Wipro. as well. So that's the overall picture. It's a very well-behaved, slow 5-point change on the Nifty.
Okay. TCS, very quiet ahead of earnings, 0.3% lower. Even Infosys, 0.5% lower. So, there's no exuberance or excitement in the IT names. We haven't seen that kind of a build-up at all. Actually, even for the month, if I look at TCS, it's done nothing. It's down to 2.5%. So unlike some of the previous quarters, there's no positive build-up on large IT ahead of the numbers. Let's see what else is down. Reddy's is lower, Cipla's is lower, Sun Pharma is lower. So Pharma is not too hot this morning. Market is now absolutely flat, blinking red and green. On the upside, some of the financials are looking quite okay. Shriram Finance, 0.5% up. Axis Bank, 0.5% up. Bajaj Finance is not too bad. ICICI Bank is up. SBI is at least having a positive start in the green. And Reliance was fairly volatile yesterday. It's sitting on the fence right now with just about a 3 to 5 rupee up move. That's Reliance Industries. Tata Steel is the best performing stock on the Nifty for the moment with a gain of 0.7%. And now we're struggling to do 1 point or 2 points also on the Nifty. So back down to flat.
Not fair, guys. I go third. So, by the time you come to me, it's already flat. The 20-point gains have gone. But, a few stocks in the broader markets are buzzing around. Enviro Infra Engineers, the JV bagged a 390 crore project. So the street likes it. That one has been doing well. It's up close to 4.5%. Volume's fairly decent. SPML Infra, that's another stock I was looking at. In the last few months, the stock has moved, I think, from around 180 to 280. Today, it's up close to 10%. So that's coming one of the top volume gainers out there. PFC and REC, I think there's a brokerage call that's coming in there. A couple of them have mentioned that post this recent correction, actually, it's providing a good entry opportunity. So explains why both these two names, in fact, have perked up in trade. On the flip side, you have Quick Heal. That's falling on decent volumes, actually. That's down closer to around 3%. I'm not sure whether or not there is some news flow on that one. But that's down 3.5%. The other one you're looking at is Metropolis. That as well is seeing a bit of a knock in today's trading session. So just keep an eye out on that particular name. And Dream Folks, post this news that's come out with regard to some of those, clients they've been losing and it's impacted their business. In a month, the stock has gone from 270 to around 165 rupees or thereabouts. So difficult times for this one.
It is absolutely the case, difficult times. Markets, though, I think now are down, 3.5 odd points in terms of the change, as you can see up on your screens. We'll talk about individual sectors, names, etc. as we go along. Now, Dream Folks, I don't want to talk about the stock per se, I don't know if you have a view even, but what do you make of the entire it kind of, not in a straightforward way, but talks about, the lesser talked about variable in every sector, which is the big, the competition risk in that sense. Here, of course, it's disintermediation, if I can call it that.
That's right.
But any thoughts at all here?
But I think that what you're saying is true. No matter what sector you're in, there is disruption and, if it's not from competition, it's either from technology or AI that's coming in as well. And, I think the IT sector in particular is vulnerable to that. That's a real problem in this country. I mean, you could have an irrational player come in and actually damage the industry and take away market share and, survive for several years before cleaning out the competition.
And this direct quick commerce, I mean, just to sort of hop from, again, I thought of it because of competition again, right? Zepto, for example, yesterday it said they're raising money.
That's right.
More money. At
a higher valuation.
At a higher valuation. So,
No, I think quick commerce is here to stay. I mean, our view is, my boys don't order anything anymore. They haven't been to a Kirana store ever, I think. I should probably drag them out of the house once and take them. This is what a real store looks like, not the one on your phone. But the fact is that, it's here to stay. And people, I think, are having less and less patience, whether it's short reels that's causing that to happen, or it's the OTT platforms. But people want instant gratification. So if you order a toothpaste, you want it in 10 minutes. You don't want to wait an hour for it.
The reels are the biggest disruption, I think, for mankind in general, but at several levels.
Good for customers, good for shareholders as well?
Shareholders of Zepto or
I mean, the entire space, Zepto's, Eternal, Swiggy, do you think, because I'm very, very happy, using the services.
Yeah.
But as a shareholder, would you say that the better time's coming for them?
Yes, because they are taking away significant market share from the Kirana stores.
Yes.
The Kirana stores, of course, there will be some political ramification at some point when they say that, these guys are hurting. they are already hurting, but maybe they hurt even more before somebody takes up their issue. But the reality is, they're here to stay. So probably definitely good times. But specific on Eternal or Swiggy, the competition is so intense, much like the paint industry, where you're seeing large organizations, large industrial houses getting into the business. I don't see how the economics necessarily will continue to be strong.
So Gautam, now put it all together for us. And we haven't discussed the global backdrop, which is amazing because you look at the US market, with wars and with so many headlines, tariffs, it's just going up and up, at least for now. That so-called, great gush of FI liquidity doesn't seem to be making its way to our market anytime soon, at least on a more durable, permanent basis.
Yeah.
Coupled with everything that we've discussed, earnings expectations are low, valuations are high. So what should an investor be doing here in India?
So let's understand what's driving this market. It is pure fund flows, okay? And you got to hand it over to the Indian domestic investor, continue to put money month after month after month. I mean, yesterday's number was, I think, a big shocker to me personally.
23,500, yeah.
Well, that was a net number, but the SIP was 27,300.
Yeah, SIPs were fantastic.
So that's obviously a new record high.
Yeah.
So let's see what's driving that and pertains to what's happening back in the States. If you look at here, you're looking at extremely low savings rate. HDFC's, and I have an account with HDFC Bank, their savings rate is 2.5%. Fixed deposits, 1 year tenor down to 6.25%. So would someone like me be incrementally putting more money in the equity markets? Probably yes, to try and beat fixed income returns. Secondly, if you look at the average age of the investor, I was looking at the NSE Market Pulse, and they have some pretty interesting raw data in there. 40% of the investor base, unique investor base, is below the age of 30. 70% is below the age of 39. If you look at the top 5 states, Maharashtra, Gujarat, UP, and Rajasthan, and West Bengal, this is where the top, about almost 50% of the unique investors come from. If you look at incrementally, where are the new investors coming from? Include states like Tamil Nadu and Bihar. So the equity culture has only just started. I mean, there's more to go, more states to hit and penetrate. So I don't see that slowing down from an India perspective. Yeah. As far as the US is concerned and FI participation is concerned, the fact is our market's trading at the same valuation as the S&P 500. FIs, when you look across Asia, for example, you got earnings growth that matches ours across Korea, Taiwan, and China for this year. So we're not cheap. FIs have more options to invest in, and the earnings growth back home in the US is huge. Yeah. First quarter, calendar 24, S&P 500 earnings grew. All 500 companies' average earnings grew by 12%. And that's 28% for the Max 7, 9% for the balance 493 companies. So that's huge earnings growth, and we don't have that here.
Yeah. Explains a lot. So what should one be doing? I mean, in terms of, like you said, as investors, I mean, we need to be in the equity market for the reasons you just mentioned.
That's right.
But we have all of these headwinds. So where should that money be put?
Money still can be put in the equity markets. Doesn't seem to be an alternative. I mean, gold's the other option in terms of an asset class.
Where in the equity market?
So here's the thing. I know you're going to pin me down on that, but the reality is, of the 1,200 stocks, we ran this screen only last week, of the top 1,200 stocks by market cap, 890 stocks over the past year or so are up 25% or more, which means 300 stocks have underperformed. Second, and more importantly, if you look at over the past 2 to 3 years, there are total sectors that haven't performed at all. I mean, we discussed shoes, we discussed QSR, with the exception of 1 or 2 companies that have actually done well. I mean, even TCS over the last 3 years has given us mere 6% return. So there are a lot of sectors out there that haven't done well. And I think the other element to look at are companies which are undergoing a special sit. So we run a public market fund, which is a special sits fund. So you're looking at P's getting into in terms of ownership or taking chunky stakes. We've seen a lot of that happening over the past several years. You're seeing promoters sell out. That's a big theme. M&A happening in the industry. So there are a lot of chunky things, deleveraging happening. So there are a lot of opportunities that are actually there, but you got to roll up your sleeves and find them.
All right. Gautam, final question from mine before I let you go. I recall being at a cement plant to visit more than a decade ago, and you happened to be there as well. I think I was the only business journalist that managed to sneak in there. Yep. And the street is optimistic. The second half of the year is going to be better for cement companies. And, to be fair, price increases is something that's been good. That's been the lone positive. Hopefully, demand catches up as well.
Yeah.
What's your view on this theme? And do you believe some of these smaller cement players or the ones that have underperformed in South India are better placed?
Yeah, so I think cement's a very regional business. So South India traditionally has not been best in terms of pricing power.
Absolutely.
We haven't played a cement theme as yet. We played it more through construction companies and other ways to play cement. But is the horizon bright? I think the horizon is indeed bright, but it's not going to be, EMS.
So that's not one of your preferred sectors.
It's not a great preferred sector as yet, but it's not going to have great earnings growth. But I think there's consolidation happening, and hopefully that's going to give it even more pricing power.
All right. EMS, you just briefly mentioned that. That's a theme that you've liked in the past. It has a big runway ahead. Valuations, it's debatable where exactly the stocks are at. But would you be looking any kind of bad news to buy into some of these names? Stocks like Dixon, you've had various contradictory reports in the last couple of months. Some very positive, some very negative. But, 1,350 odd, where the promoter offloaded some stake, that seems to be the zone. It goes there, it bounces back very quickly. Your take?
Yeah, my view is not specific to Dixon, but my view is that EMS is a growing industry. You're still seeing Dixon as an example, giving 80 to 100% quarter-on-quarter top-line growth.
Yes.
So my view is that this is an area one needs to remain invested in. Will the valuation sustain? And that's really something you got to think about. 70 times, 80 times. Some of the other names which are tier 2 versus Dixon are trading at half the valuation. So those are interesting too.
You want to name a couple of them? I think Sirma is one stock that we had discussed in the past.
We don't own it anymore. We own Amber, so that's something we're building a position in, so full disclosure.
Okay, all right. So some ideas finally. See, Nigel managed to pin you down.
I know.
Let you go.
Drinks on me.
Thank you so much, Gautam. Great conversation, and thanks so much for stopping by at the studios this morning.
Thank you.
All right, well, that is the market construct. The market, by the way, is now down 21 points. Mid-cap index is flat. Bank Nifty is also flattened out. Continues to be very, very quiet out there. So for the time being, let's put the spotlight on the textile sector. And that's in very, very sharp focus because hopes are running high. Hopes are running high with the expectation that perhaps India will eventually get a more favorable deal and a more favorable rate of tariff than some of the biggest competitors when it comes to apparel and textile. Competitors like Bangladesh, which is at 35%, Vietnam, which now we know is at 20%. So what awaits the Indian textile story? Well, joining in to talk about this, we have Mr. Sudhir Sekhri, Chairman of Apparel Export Promotion Council, as well as Pallab Banerjee, Managing Director and Group President at Pearl Global Industries. Gentlemen, thank you very much for joining in. Mr. Sekhri, if I could open with you, and this makes me a little nostalgic because I started my journalistic career reporting on textiles and apparel, and this was way back. I don't want to reveal my age, but we're talking about the era when, WTO quotas were ending and India was supposed to seize the opportunity in apparel. We did it to an extent, I think, in home textiles and, linen and towels, etc. But then countries like Sri Lanka, Vietnam, and obviously Bangladesh stole a march over us. Now, what are we looking at? I mean, we don't know the final tariff that India gets. There's also the India tariff plus a BRIC tariff. So maybe it's 10 plus 10, 20%. We don't know. But looking at 35% on Bangladesh, do we have a real chance of, a major milestone turn when it comes to our apparel exports?
Yeah, okay. Thank you for having me over. Well, you're right. We have over the past few years, we have been laggards, so to say, and as compared to our neighbors and competing countries like Bangladesh and Vietnam, and that's because of the policies that Bangladesh, for instance, has an FTA with EU, which we don't have, so they have a huge advantage. Most of the EU retailers, they source around 50 to 70% of their apparel from Bangladesh. So that's a big setback for us. But I think that is going to be addressed very soon once we sign on the dotted line with EU. Coming back to the US, yes, the signing of the FTA has again been and will give impetus to our the apparel trade, and with the BTA with the US in the offing, I think that's going to be a game changer for us. And we believe that AEPC had set a slogan 40 by 30, and I think what the events which are happening, the BTA, the FTA with the EU, that is really going to take us on that ride. of 40 billion by 2030.
But Mr. Sekhri, let's also talk in terms of, numbers, and we can only play out scenarios right now because we don't have the final tariff. If I remember correctly, I think our current blended tariffs for apparel exports to the US is somewhere around 5 to 7%, I think 7% from what I gathered. Correct me if I'm wrong. Now, if this goes up to 10%, which is current baseline, if we somehow manage to escape this additional 10% brick duty, what does it mean for our apparel volumes at 10%? And if Mr. Trump levies the BRICS duty as well, which means we're at 20% tariff, then what? Then it could be a setback, wouldn't it?
Surbhi, the numbers,
First of all,
the numbers, I don't know, because I remember Gokul Das, I have, when we spoke Gokul, they said that US already imposes 15 to 30% on apparel imports.
On Indian apparel imports.
On Indian apparel. So the range, it depends on what item, but between 15 and 30.
Okay.
And then there was 26%. So it is 26 plus at least 15, if not more, already. I mean, currently.
Yeah.
If you just take a look at what was announced on Liberation Day. And now we're talking about change from that point. So it's already pretty steep. I mean, 35, 40% if based on Liberation Day tariffs. And now we're talking about whether it's going to be higher or it's going to be lower. So just that
Mr.
caveat.
Secretary, just weigh in on this as well. I mean, since you represent the whole sector, the average tariff pre-Liberation Day and where we could be looking at the various numbers that are doing the rounds right now.
Okay. Let me first tell you what is when you talk about pre-Liberation Day, that's called MFN tariff. Okay.
Yeah.
The MFN tariff ranges from anything from 2% to 32%, depending on the category. It's line-wise. It's not a same rate of tariff for every product.
Correct.
Especially for man-made fabrics, it is much higher than for cotton. So on an average, what your colleague just said, on an average, it's about 18%. Okay. Now, with the 26%, which is not going to happen, quite honestly, this 26% tariff is not going. Reciprocal tariff is not going to happen. We are looking at something between 10 and 26. Now, based on our conversation with the Ministry of Commerce, apparel, it's because it's being a labor-intensive industry, that is a top priority for our government. And they are, they will go all the way to ensure that our industry is not hurt, because if our industry gets hurt, it hurts our employment potential also. So the government is aware of that, and they are very supportive of the fact that our industry needs to. Now, come back to, see, when you talk about compare with Bangladesh, now Bangladesh was just hit with, I think, 30%.
35%.
35%, okay? Even if we, as a worst case scenario, even if we go to 26%, we are much better off than them, okay? Now, our other competition is Vietnam.
Mr. Sekhri, sorry. So then if in the worst case, what is the tariff, effective tariff then?
Effective tariff will be MFN plus 26% before the BTA gets signed.
Yeah. So in India's case, it's average 18 plus 26, right? That is 44%.
Yes.
Then.
And Bangladesh would be MFN plus 35.
Which is what?
You see, MFN, first of all, please try to understand, MFN stays there.
No, I'm saying what is that effective tariff for Bangladesh against our 44 in worst case? What is their number?
35 plus MFN, which is 18 plus 35.
18 plus 35. Okay, so even then it's going to be lower. But you're saying it's in our case, your expectation is going to be 18, which is the average, plus something between this 10 and 26%, right?
Here I'm being very, very pessimist. Otherwise, I think, based on the assurances that have been given to us by the government, I think some lines may even end up with 0%. When I say 0%, please realize I'm not talking about MFN. MFN is something that Mr. Trump can't do anything about. This has to be done by the Senate and the House of Representatives. Okay, that is
in the case of Vietnam, sir, Mr. Sekhri, what is that number?
It's 20% plus MFN.
So that is 38%.
Yeah.
Okay,
right.
So it's kind of in that, it's all coming to in that 30 to 40% kind of range so far, what we've seen, right?
That's right.
You're saying we should be better off.
We will definitely be better off on certain lines. On a few lines, perhaps, because we are negotiating. What the government is trying to do is, on a slow-moving lines, let it be a little higher if they wish to. But on the fast-moving lines, they will definitely gun for a lower reciprocal tariff.
Okay. Got it. So that kind of clears up the numbers that from an MFN perspective, we were at 18% average for apparel and textile exports. Now we need to see. So MFN 18% plus question mark.
Reciprocal tariff, whatever it is.
Yeah, whatever is eventually decided. Now, whether it is, 10 or 20 or 20, not 26 like you're saying. Got that. So that clears the math. Let me come to Mr. Banerjee as well. Mr. Banerjee, I mean, you have, large operations. And I mean, a business like yours, I guess, to an extent, you've already de-risked because you've got facilities, I believe, in Vietnam as well. How would an exporter like you, how are you preparing for all that happens? And for your own business, now that Vietnam tariffs have also gone up, what does all of this imply?
Thank you, first of all, for having me on this show. So if you look at the whole manufacturing and the sourcing sector across for this textile and especially for apparels, the biggest country of exports is in China, followed by Vietnam and Bangladesh. These are the three topmost. And then, of course, after that, we have got countries like India, Indonesia, Philippines, Turkey, all these countries who manufacture that garment. And they globally, even if I speak specifically for USA, they have been sourcing from these countries. So whatever they do, immediately a shift would be difficult. For example, like if India, all of us are hoping that get a much better deal. In that case, over the next few years, we have to really ramp up our capacities and capabilities as a country to service this huge potential. Currently, this potential is lying in countries like Bangladesh, Vietnam, and China. One thing is very clear with what's happening from the Trump administration, that de-risk what was spoken about in the in the 15s and 16s and 2017. Now it is becoming more like a decouple. So naturally, as the business moves from China, the two countries which are benefiting or has been benefiting in the last few years have been Bangladesh and Vietnam, who's taken the maximum benefit out of it.
But Mr. Banerjee, that's exactly what we're trying to understand, because obviously, in line with the perhaps smart business positioning, Pearl, for instance, and I'm just taking this as an example, you already had set up facilities in Vietnam and in Bangladesh. If you could just tell us from your current revenue, how much is coming in from your plants in Bangladesh and in Vietnam? I mean, as a rough percentage. And what happens now? Because suddenly the exports from these geographies become uncompetitive. Or maybe, I mean, it's kind of more difficult with respect to those higher tariffs. India will talk about in a bit. Yeah. But what could be a potential hit to you, given the rise in tariffs in both of these countries where you operate?
Yeah, what we are seeing is definitely a positive traction at this point of time. Bangladesh has an advantage because of LDC status. They had a duty-free advantage to the European Union, UK, Canada, China, they have for ASEAN, and a lot of these kind of benefits are there. Like Australia is also a duty-free for them. So that become a hotbed for apparel. And that's why that country, if you see like almost 85% of their exports is in apparel and to all these countries. So what we are seeing is that positive traction continues. If this US, they have given a time till 1st of August to renegotiate, and if Bangladesh can't do anything, then we will see some migration of the US business from Bangladesh to countries which is more favorable. That is one.
Can you just give us an estimate? Yeah, absolutely. Got your point. So some of the other countries, I think you'll keep exporting to them, EU, etc., like you mentioned. Out of your total exports, how much is going to the US? And within the US export number, how much is going from India and how much would be Bangladesh and Vietnam?
Yeah. So US is about anywhere between 48 to 50% of our total revenue.
Okay.
And if I look at Bangladesh almost about 70% is going to the non-US countries because of the duty tariff benefits that we have for the other trading partners of Bangladesh. And if you talk of Vietnam is a very heavy for US. And if you see like the negotiation that Vietnam government did with US, some of these US retailers were part of that discussion. So naturally, there's a lot of interest from the US buyers to secure their, trade with Vietnam or countries like, Bangladesh and Indonesia and all. So that's something we saw happened in Vietnam. One of the things that we heard from Treasury Secretary that, maybe this number, what they talked about is 20%, is independent of any other tariff. So we don't know as of now because it's just an interview I think he gave with CNBC day before yesterday. Now, what is the actual fine prints, how it comes out, all those things industry is awaiting.
No, absolutely. I don't envy your position at all. I mean, I can imagine the sleepless nights just wondering which tariff missile is going where, and you have hard assets on ground, businesses on ground. So, Mr. Banerjee, just to sum it up, for the current year, FY25, can you give us some guidance or any guidance at all? I mean, will there be growth? How much growth? Are you scaling back your projections because of all this uncertainty?
No, you see, the industry, humankind has to wear clothes, whether it's US and other markets.
Till we find a way not to.
So what we have
well said.
Is that definitely, the first deal that has happened.
I'm just kidding. I should introduce some levity into the conversation since Surabhi said both of you are having sleepless nights. Go on, Mr. Banerjee. Go on.
So what we are seeing is definitely with this complete deal, as per the US president says, that has happened with Vietnam. So we are seeing a lot of positive traction because of that. I think what we are seeing is that the whole year at this point of time, the capacity is getting booked, a lot of interest from the retailers and all. With Bangladesh and India, still in a question. Some of them are in conversation with us. They're saying that, okay, we should give them the flexibility. If whichever is lower in terms of tariff, we should be able to move and show that flexibility of moving the production to that country. So this is the kind of conversation that is going on with our customers on day-to-day basis.
All right. Thank you both for joining us. It's a pleasure having you here. Appreciate you sort of coming on. And I must urge both of you to join us when we actually get the rates. I think it's a fascinating, insightful conversation we've had. And I think we got to learn a lot. And so did our audience, I'm sure. Thank you very much, Mr. Sekhri and Mr. Banerjee, for coming on here on the program. Well, the next conversation is very much about the markets themselves. I mean, we're not talking about companies listed on the market. We're talking about the market, stock exchanges as a business. We have Metropolitan Stock Exchange, which is on our radar. Why is that on our radar? They've announced that they're raising 1,000 crores in funding. There are venture funds, brokers, AIFs, which will be investing and putting this in total 1,000 crores. And this is the second sort of round of fundraise that we've seen come through. To talk about this fundraise in detail, but of course also talk about the timing of this and what the bet really is here, we have Latika S. Kundu, Managing Director and CEO at Metropolitan Stock Exchange right here in our studios. Ms. Kundu, great to have you with us here. Thank you very much for dropping by. So I want to start with, this is a very interesting time that you're doing this because there is so much focus, regulatory focus on what has been the single biggest growth driver for the market expansion, which is the options market, right? A lot of regulatory focus. I don't need to go into the details. We all know that. And yet you're able to get about 1,000 crores, a new funding round from some marquee investors and a bunch of brokers, market makers, etc. as well. What's the pitch that you have for them?
Well, I'll take a step back before I get into the pitch. And that is, the larger purpose is always that we are able to create markets which are for investors, which are healthy, which will be more inclusive, which will be able to create a competition. And I think that's the one thing that's still lacking today. We can see a near monopoly on the cash side of the market, a duopoly on the options. I know everybody's focus is on the option side of the market, and that sounds very exciting. But looking forward, we see to growing a sustainable exchange. And for that, we need the cash market to be equally healthy and to be taken care into a deeper penetration across all strata. So we're looking at a mix where we will have the institutional, the retail, a mix of all types of investors, because the entire focus is not just about having one more platform. It's not that. It is about actually wealth creation into the country.
No, that's the baseline. That's the baseline that we work with, and then we kind of sort of, that need be said. I mean, that's understood. But Ms. Kundu, I'm sure you have Tuesday as the expiry.
Yes.
The options expiry day.
Yes.
Right. I mean, that's a powerful card that you have when you went and raised this money, I'm sure. I mean, without that, I doubt whether you would have gone to the market and been able to raise the money. So it is still for investors who they're looking to raise money, really. So what is your strategy going to be? How are you going to do it? As you said, it's a duopoly right now. There is NSE, there is BSE, entrenched players. Exchanges globally are also very strong network effect players, right? I mean, something which does well, continues to scale, does well because it is doing well. So in a way, benefits beget benefits. So just what will MSE do in that sense?
So in that sense, of course, we had, you spoke about why they came in for the Tuesday. Some people spoke about the first fundraise, them coming in on the exclusive Friday, which has now become a common Tuesday. So I think the larger picture is about, seriously, yes, options market, we will be penetrating into because we do have an exclusive index, SX40, which lies right between the sensex and the nifty. And we see that as a very opportune benchmark index, which does have its own features and qualities, and it sits right in the center of the 25 and the...
So MX40 is the...
SX40.
SX40 is the index?
Yes.
And everything will be underlying
40,
on the...
Yeah, which are the large 40
and
caps.
how does that derive its prices from? Because...
So, of course, that's the reason I said that, looking at the sustainable exchange, we would be saying that, it's the cash market that we look at as the primary focus to start with, to bring in the liquidity. And as I said, it's a near monopoly there. Because for us, as market creators, we need to look at it in a more holistic way. Do I have a healthy market? Is it competitive enough? Am I providing enough to my investor? Am I really reaching the goal that the regulator and the country is looking at from a longer perspective? So to do that, focusing just on one options market will not be sufficient. And that is not what we are only looking at.
Is there a message you've got from the... I'm sure you've been in touch with the regulator, etc. as well.
We firmly believe in.
Okay.
This is a message that we firmly believe in, that,
So cash before options? So
cash before, yes.
Has to be.
Yes.
All right. Hi, ma'am. Thanks a lot for joining in. A couple of basic details then. If you could tell us, most of the companies are listed either on the BSE or on the NSE.
Yeah.
Could you tell us what is your strategy with regard to getting larger number of companies listed on your exchange? If you could help us out with that, what is the strategy out there? Also, if you could give us a few more details on numbers, number of companies, number of members that you have, broking members. What was it, say, 3 years ago? What is it now? Where is it headed? Both those two basic details on companies and brokerage.
Thanks, Nigel. So basically, we do have about more than 200 uniquely listed companies which are not on any other exchange.
Okay.
There are, of course, the other larger companies which are out there on NSE and BSE, which are not listed with us, but they are in the permitted to trade category. This is the same for every exchange that starts. It was so in NSE 30 years back, where you started off with permitted to trade category, and then slowly you list on as you build the liquidity. So I think the focus will be, I'm sure at some point they will come in and list, and that will be also our focus for the existing listed.
Okay.
For the new set of companies, we definitely will look at them coming in, having their IPOs with us for the the platform.
Has the feedback been positive?
We do see a lot of interest gathering. Members, we do have more than 560 members which are registered with us.
Okay.
There were, of course, many more at some point of time when we started off 17 years back and were a competitive exchange. Now again we're looking at a re-startup model, and we see that will propel through the challenges we have gone through. It's fair enough, but we will look at new companies coming in, listing on our platform, as well as even companies which it could be that in a new category of companies that we may look at that could come in, while getting all the existing companies also slowly coming and listing on our platform.
Ms. Kundu, just want to understand if you can share some milestones, I'm sure some targets that you've set internally in terms of volumes. What are those, by when, how much, if you can give us some sort of timelines, and also how many brokers are with you right now? I think some of them are also investors with you. So if you could just tell us how the scale-up is going to be in terms of getting more volumes on the exchange and bigger participation from brokers.
So we have almost more than 550 odd members who are already registered with the exchange. We are slowly seeing the activation increase. Last 6 months has been a positive turn with more and more members, not only the existing ones activating, but also new members coming in. of different categories who are coming in and applying for new memberships. So we are seeing a positive turn on that end. Connectivity is coming in. We have been rolling out new infrastructure. State-of-art data center is what we are going to be now, giving in the next few months. So we are all in the readiness to make sure that we are market ready, future market ready in terms of infra and tech space, so that when members come and connect, the feel-good experience is very much there on the table for them. So that is what we are focusing on.
Advertising blitzkrieg as well?
Sorry?
You will need to reach out, right? Advertising.
Yes, so we will start with roadshow. We haven't really started on the advertising, but we will, of course, slowly roll out an entire PR plan and a marketing plan.
But how will you fund all this? Because I believe in, let us know the numbers. I think the operating income last year was around 4 crores. So as you go about investing in technology and, the exchange architecture, marketing, how will you fund all this?
Yeah, so the first round of funding did help us with, being able to allocate a good amount of number to the tech space, as well as expansion on general purpose and business, obviously expansion growth plan, whether it be including people. So infras, of course, and tech space is going to be the bigger spend. And road shows through other, marketing techniques, of course, we will.
Yeah, in a way, a lot of the brokers who've come in, I'm assuming they've also been, you've brought them on the cap table because, you've got to make markets, right? You've got to have activity. So the brokers, etc., should help in that sense. As shareholders on the cap table.
Well, I'm sure that, that is something that brokers do see an opportunity.
In a way, it aligns their interests.
Yeah. I would say everybody is looking at, beyond a near monopoly on the cash side of the market, and also having, in every sector, in fact, just to move even beyond the exchange space. If you see any sector, the more the competition, it helps not only the sector, it helps every participant, including the existing players, because the market size is only there to expand.
It's going to give us a number. It focuses the mind in terms of a target, what Surabhi said.
Volumes, your targets, and for your internally, your own revenue and profit estimates.
So I think we are looking at a 3-year horizon from now, where we look at ourselves becoming completely sustainable in terms of an exchange, and also in terms of liquidity. At least within the range of 10 to 12% on the cash segment side of
12 to 15%,
10 to
12% cash market share in 3 years' time.
Yeah. So accordingly, we feel that even the propel on the derivatives would happen. But it will be obviously a slow progression. And while I say that, I think it's not just about the market share. The market size itself is going to grow. I'm looking at we are in a country, we're proud to be in a country where we are just 28 years old. We have a mindset today. We always had a mindset of saving. Today we have the mindset of creating wealth. When that is the propel, so that means I'm looking at a good close to 500 million people at least, who should become becoming proper investors, and having, whether they come through SIPs, they may not come directly to the market. We do understand the concerns on creating that healthy market, and we very much would like to propel that further.
All right, so you turn profitable in the next 3 years is what you're saying? EBITDA positive, market share of around 10 to 12%, and you look to make some entry even in the derivatives market. BSE struggled for around 20 years, but they finally made their mark, so we'll have to see how that goes. Very quickly, that market share is interesting. NSE needs to could possibly list in the next 12 months. They'll list on your exchange as well? Any kind of conversations?
That is something I think you will have to ask at NSE. But we are more than happy to have anyone, that is what the markets are for, that you are supposed to list on any of the exchanges. So yeah, why not? If they do plan that, we are more than happy.
Competition and support each other as well. That's going to be interesting.
Of course. That's the way it should be, because when it's a healthy competitive market, you will all grow. Everyone will grow.
That's a very specific, nice, interesting point, Nigel.
Need to come up with something interesting, right?
No, given the interest levels in NSE, that could kind of provide the spark. And a new stock, a big one, biggest exchange, listed, and I mean, yeah, as you said, they are supposed to list. I mean, they were supposed, if they list in a BSE, but now with MSE as well, if it's, why not, as you said?
Yeah.
Why not?
I mean, investors want a pie of the whole capital market space in one form or the other. So perhaps they'll be tracking your progress as well.
And
very,
more
very
the
carefully.
platforms and more the platforms, I think that only allows de-risking also of, the entire space.
Sure. Okay, all right, ma'am. Thank you very much for joining in and discussing the roadmap ahead for you in the exchange in terms of growth. Let's quickly move on and address a very, very important story that our colleague Timsy is bringing about. This is something that oil marketing companies and their investors have been awaiting for a long time. What will happen to those LPG under recoveries? Well, Timsy is picking up from sources that there could be a fund that the government is setting up for this. Timsy, morning. Tell us more.
Well, yes, that's what government sources indicated to us, that the finance ministry is considering setting up a fund which could range between 32,000 crore to 35,000 crore rupees, only to cater to the OMCs under recoveries that are happening on LPG. The Petroleum Ministry has demanded about 40,000 crore rupees for this, but Finance Ministry feels that about 32 to 35,000 crore rupees of fund could be what can be taken up for a cabinet's approval to cater to this demand. And these proceeds, basically, where will this fund come from? Where will this money come from? Well, sources indicated that these could come from the petroleum excise duty proceeds that the government has raised till now. They'll use the excise fund for this. And the view behind agreeing to take this proposal forward for the cabinet approval is that oil companies are part of the same government family, and government cannot let them suffer by themselves. Their demand is justified and they need to be catered to. Thus, a compensation can happen very soon. That's what government sources, senior officials indicated. So let's see what happens. What happens now, how soon this proposal goes to the cabinet, because Finance Ministry is just finalizing the contours, and soon a cabinet approval could help OMCs overcome these losses.
All right. Interesting story there, Timsy. Thank you very much for that. We'll take a quick commercial break here. We'll focus back on the market with some trades with Mitesh, but we also have an interesting primary market company coming up in just a bit. Stay tuned.
Welcome back. Okay, now the market has chosen its color for the morning, and the color is red, 50 points lower on the Nifty. Let's go across to Mitesh for some trading advice. Mitesh, on the index, first of all, looking at this opening and now where it's settled, what would you do? And of course, stock ideas as well.
Morning again, Surbi. I've been totally avoiding the index, and you can see that, while it's a 40-50 point kind of move, in percentage terms, it's hardly anything, and the market is still showing signs of contraction. But on stock side, I think a lot of technology names are giving you negative signals. So I think I have chosen HCL Tech as one of these sell calls. Keep a stop at about 1676, look for targets of 1620 to about 1615 on the downside. And Nykaa is seeing good follow-through action. So that's a buy, continuation buy. Keep a stop at about 211.5, look for targets of 225.
Okay, Mitesh, come back to you later. Thank you very much for joining us. We have to take one more commercial break. I have to do that. But on the other side, the management of SmartWorks co-working spaces will be with us. Interesting company. They're coming up with a near 600 crore IPO.
Welcome back. Well, let's focus on some primary market action then. SmartWorks co-working spaces, 580 crore IPO opens today for subscription. They have set the price band in that vicinity of around 387 to 407 rupees per share. They've also raised 174 crore rupees from the anchor investors. Let's discuss a little bit more on the IPO offering. We've got Harsh Bidnani, the executive director, and Nitesh Sarda, the managing director at SmartWorks co-working spaces, who joins in. Hi, gentlemen. Good morning. Welcome to the stock markets and all the best for this issue. Well, let's get a basic point out of the way first before we discuss more about your business model. You're raising some money and you said you're going to be reaping some debt on that front. So tell us, what was the debt before the IPO? Once you get done with it, what does the debt come down to? And effectively, what would be the rough interest savings?
Thank you, Nigel. It's a momentous day for the company, and thank you for having us here. We are very grateful for the overwhelming support. Yesterday, we had a big anchor allocation, and we are now opening it up to public. The IPO of ours will have a primary raise of 445 crores, which will include 114 crores of repayment of high-cost debt, and the lion's share of the balance will go towards our expansion. In a post-IPO environment, the net debt of the company, which earlier stood at 299 crores in March 31st, 2025, we also had cash balances of 100 crores. Once we repay this high-cost debt of 114 crores, the company is actually going to become net debt positive.
Okay.
And today, we are very excited, especially because, as we've seen, Morgan Stanley widely reported that India is going to be the office to the world. Today, our Prime Minister Modi ji has an ambitious vision of making the country a developed economy by 2047, where the economy is going to grow to about $30 trillion. You can only imagine how much the requirement for office spaces is going to go up during this period of time. And we are here today to fuel that transformation of Enterprise India. And we are extremely excited about the limitless possibilities that we are going to see.
Okay, all right. A couple of targets then. If I look at your total, I think you'll have 10 million square feet. You could correct me on that number. And it's moved from 6 to 10 million square feet in the last few years. Where is that number headed? And also number of seats. Currently, I think the capacity is roughly around 200,000 odd. So what would the ambition be? Not in the near term, but say 3 years down the line.
So our growth trajectory has been quite fast. If you look at our growth, as you rightly said, 6 million has moved to 10 million already. Just in the last 3 months, since we've declared this in our RHP, we've signed an additional 1.5 million square foot, moving our total asset under management to 11.5 million square foot. If you look at this space, Nigel, it started off about 8 years back. It's grown to 88 million square foot across India.
Yeah.
This industry generically has been able to grow faster than traditional office spaces. If you look at the projections, CBRE has said that this industry will grow to almost 140 to 147 million square foot in the next 2 to 3 years. So the potential is really, really wide. We have been able to become the largest managed campus operator in the country today. We have over 50 centers. We have over 10 million square foot of space, which is already operational, and are present in 15 cities. Our focus is a little towards mid to large enterprise clients, where we cater to their requirements of over 300 plus seats. And that's the reason we've been able to scale faster than anyone else in the market, because we take large individual buildings, convert them into campuses, and give it out to large enterprise clients.
Gentlemen, morning, and congratulations, as Nigel said, you've come into the market. Nitish, if I can ask you, what are margins like in this business, and where are they now? What do you aspire them to be? How can you grow them? What are levers here?
So if you look at our trajectory, in the last 3 years, margins have grown by almost 3.5 times. Our adjusted EBITDA, which stood at 35 crores in FY23, has grown to 172 crores in FY25, with a base increase of from 6 million to about 10 million square foot, and a revenue increase of only 1.7 times, from 700 crores to 1,374 crores. So while the revenue has increased by 1.7 times, our EBITDAs have increased by 3.5 times in this. The growth potential in the industry, as I said earlier, is to scale this up significantly. 147 million square foot is also just a drop in the ocean. As Harsh mentioned earlier, we are becoming the office to the world. The demand, if you look at in India for office spaces today, just the first quarter of this year had more than 48 million square foot of absorption.
Yeah.
So this
I wanted to come to that. So what are margins now
So our margin last year was at 12.5%.
Okay.
The margin has seen a steady growth trajectory. But the real strength of our business is not in our margin. We are a cash flow strength company. If you look at our margin and compare it with the cash flows, it was actually 240 crores. The trajectory that we've been able to demonstrate during this period has been on an upward curve. And every business, when you start to seed, it initially requires a lot of investment to build it to a critical mass. Once you've reached that critical mass, that's when you start to see enormous profits.
Okay, so just to office to the world, just last question, Surbhi. GCCs are the big growth driver, right? Captive centers. you have them as customers?
We service a lot of GCCs. But how I would give the sectoral mix is that India, about 55 to 60% of India's commercial demand comes from IT/ITES. For SmartWorks, that number is 42 to 45. We've not only focused on IT/ITES, but we've also diversified our sectoral base by getting companies in manufacturing, healthcare, BFSI as some of our clients. So we've really distributed our client base across all sectors. And while GCC is seeing a significant amount of increase, but even Indian companies, homegrown startups who've reached a certain size are taking a lot of office spaces.
Okay. I just have a very small, few quick fire, like specific questions for you all. You said the company is throwing up about 240 crores of cash every year. Part of the issue proceeds are being used to retire debt. How much debt will you be left with, or will you be able to pay off everything, with the fact that you have cash and you've got the IPO proceeds? If you could just start there, just give us clarity.
Once we repay the 114 crores, the company will be net debt positive. What that means is that we are not going to be debt free, but the company is going to have very healthy cash balances. And we are repaying debt.
How much debt will you be left with?
We will be left with a debt of close to about 200 odd crores.
Okay.
And we are repaying debt in a very aggressive manner. And the company's growth trajectory is also starting to see massive revenue creation. In 8 years, which includes 2 years of COVID, today we are at about 1,350 crores of rental revenue.
Sure.
When you juxtapose this with one of the largest real estate companies, which has a legacy of 80 years, their office rental revenue is about 4,000 crore.
Okay, so you after this whole exercise, you'll be left with 200 crores of debt and roughly 240 crores of cash. Now I just want to come to that, the model itself. How much of your campuses are owned by you and they're assets on your books, and how much are on a lease rental model? I mean, what's the thought on that going forward?
We're a completely asset-light model.
Totally asset-light.
We do not
okay. So you won't be owning any of the assets.
We take it on long-term leases. That's the reason with only 500 crores of equity infused, we've been able to scale up so.
Okay, so just what is typically the tenure of the leases that you take for these assets and the tenure of the contracts that you sign with your clients? I mean, typically, is it like 3 years? And how frequently do the contracts come up for renewal?
So our tenures with our landlords are towards 15 years, where we have a 5-year lock-in. So post 5 years, we have the ability of moving out. But the total tenure is about 15 years. On the client side, we do more long terms because of our focus on mid to large enterprise clients. 63% of our revenue comes from customers who are taking 300 plus seats. When a customer takes more than 300 seats, they are happy to give you much longer tenures.
Which would be
our
how many
average tenure is about 50 months on the customer side, right?
Okay.
So it's long tenures on the customer side, but over and above that, our retention rate is as high as 86%. So even after that 50 months, 86% of the customers end up renewing with us.
All right, out of curiosity, as you'll mention, with regard to the largest real estate company and the likes, you're welcome to the stock market and good to see the IPO. But were you all approached by anyone to buy you all out? Or, instead of listing, maybe someone proposed writing a big check to you all? Did that happen?
We have approached people to buy them out. It's a very unique model that we've created in a very fast-growing space.
But you all were not approached?
We've never.
However, having said that, we today are backed, while the promoters continue holding a majority share in the business, we are backed by a very large minority investor, which is Government of Singapore-backed Keppel Land, who own a 19% stake. They are very long-term on the business, so they in fact reduce their OFSI. So they are going to reduce to about 15%. And the company also has a list of marquee investors who have not only supported us, but reinvested throughout. So we have Madhukela Family Office, Jagdish Master Family Office, Hexaware, Polycap, Deutsche Bank. So that's how we built a great coalition, and we are very excited now as we go to the next.
More details when you're list. We'll pull out some more numbers from you all. But thanks a lot for joining in and giving us all of those details.
Thank you so much for having us.
All right, well, time to slip into a short break. On the other side, our special segment, Market Masters. We'll have Lata who will be joining in. She'll be speaking to Saurabh Mukherjee of Marcellus Investment Managers. Stay with us.